Welcome to Breaking News to Trading Moves. I'm your host, here to take the headlines moving the market and break them down into actionable categories. Today we're looking at a specific and, frankly, pretty startling setup. It's S&P Global and its revised outlook for 2026.
Yeah, it's a situation that really forced a lot of portfolio managers to just stop and, stare at their screens.
It really has. We saw shares of S&P Global, that's ticker SPGI, slide pretty hard recently. Now, usually when a stock like that moves, it's about this quarter's earnings. But the core reason here was a profit outlook for 2026 that came in weaker than expected. And combined with that, you have this growing fear around AI disruption in the financial data sector.
That is exactly the narrative taking hold. It's about the numbers, yes. But, more importantly, it's about what those numbers imply for the whole business model of selling information.
So our mission today is pretty straightforward. We're going to strip this down. First, we'll look at the headline news to understand exactly what happened with SPGI. Then we're going to categorize the market winners and losers that were identified in the report. We're not here to scream panic or promise miracles. We just want to look at the facts.
We need to look at the plumbing of the financial system to understand why this matters.
Let's start right there with the headline, S&P Global's outlook. You've got the report. What are the specific numbers that caused this kind of reaction?
Okay, so the central data point, the thing that really triggered the algorithms, was the earnings per share, or EPS, forecast for 2026. S&P Global put out a forecast for adjusted EPS in the range of $19.40 to $19.65.
Okay, 1940 to 1965. To the average person, that still sounds like a pretty healthy number.
Yeah.
But context is everything, right? How does that compare to what Wall Street had penciled in?
It was a clear miss. Very clear miss. The market had modeled a much higher profitability target for that period. And you have to understand, S&P Global isn't some volatile tech startup. It's a bellwether. It's considered one of the most stable, predictable businesses on the planet.
Right.
So when a company like that says, hey, 2 years from now, we're not going to make as much as you think, it forces every analyst to basically tear up their spreadsheets.
It breaks the model. But there's usually a culprit. What's driving this lower guidance?
The commentary around it highlighted some soft momentum in 3 specific divisions: ratings, indices, and market intelligence. These are, the 3 pillars holding the whole thing up.
And this is where that AI narrative comes in, isn't it? Because market intelligence, that sounds like exactly the kind of thing a computer might just start doing.
Correct. There's this very specific fear about AI-driven disruption, and it's making investors incredibly nervous about the terminal value of these companies. The fear is essentially about the commoditization of data.
I want to pause on that word, commoditize. We usually use that for, like, wheat or oil. You're saying Insight financial data is becoming like wheat.
That's the risk. Think about it. For decades, these companies had a moat. They had proprietary data nobody else had, and they organized it in ways nobody else could.
So they could charge a premium.
They could charge a premium because there was no real alternative.
Right. If I wanted the data, I had to pay S&P.
Precisely. But now you have large language models. If an AI can scour the internet, synthesize millions of public documents, and give you a financial summary that's, say, 90% as good as S&P's market intelligence product, but for free,
then what's the premium data worth?
it's worth a lot less. And if your product becomes a commodity, your profit margins, they usually collapse.
Wow.
And we have to remember how these businesses trade. SPGI and its peers, they trade at very high valuations. Investors pay a premium for them because they're seen as these durable subscription hybrids. You're paying for stability and predictable growth.
But if that growth looks slower, or if that moat looks like it's, drying up,
then the market resets its expectations instantly. And that's why guidance matters so much more than the current quarter's results. The market is asking, is this business going to exist in the same way 5 years from now?
that's a heavy question. So the headline risk is AI. But is that the only thing dragging them down right now? Or is there an execution problem too?
It's both, and that's a key distinction to make. AI is the headline risk. It's the existential dread. But the near-term driver is execution. Investors are now scrutinizing specific metrics much more closely.
Like what?
Like ratings, transaction growth, index licensing, and the margins in market intelligence.
So they want to see if the business is actually slowing down today or if everyone's just worried about tomorrow.
They're checking the engine while the car is moving.
Okay, so that's the setup. SPGI guides lower. The market gets nervous about the future of financial data. But markets are ecosystems. When money leaves one area, it usually finds a home somewhere else. Let's move on to the winners identified in this kind of environment.
It might seem strange, yeah, to talk about winners when we're discussing a disruption that's, well, destroying value for some data companies. But the money has to flow somewhere.
The first category of winners here is AI infrastructure beneficiaries. This feels like the most obvious trait, but walk us through the logic.
The logic is pretty robust. Even if data platforms like S&P Global face disruption from AI, the AI build-out itself is a massive industrial project. You can't have AI without the physical hardware.
So regardless of whether AI makes financial data cheaper, someone still has to buy the physical chips to run the brain.
That's it. The build-out drives massive capital expenditure, or CapEx. This money flows directly to companies making the chips, the networking gear, all the data center infrastructure, and it also drives financing activity around that build-out.
So who are the specific names we're talking about in this category?
Well, the first one is the name everyone knows, NVIDIA. The ticker is NVDA.
NVDA.
They are the primary supplier of the GPUs, the graphics processing units, that run these models. They're selling the shovels in the gold rush. Then you have Broadcom, ticker AVGO.
AVGO. Why Broadcom specifically?
Because you can't just have a chip. You need to connect thousands of those chips together so they can work as one brain. Broadcom makes the advanced networking gear that allows that to happen.
I see.
And then, of course, you have Advanced Micro Devices, ticker AMD.
AMD. The competitive.
The alternative. The market loves a second source. So the takeaway here is that CapEx is flowing, really flowing, toward these hardware makers.
A violent flow, you could say. It implies urgency.
The funding demand for this infrastructure is real and it's immediate. So while investors worry about the application of AI disrupting data sales, the construction of AI is a massive revenue driver for these semiconductor firms right now.
That leads us nicely into the second category of winners, data center and digital infrastructure REITs.
This connects directly to the hardware. You've got the chips from NVDA, but you can't just put them in a standard office building.
They run hot.
They run incredibly hot, and they consume massive amounts of electricity. So you need specialized real estate.
Physical building.
The physical buildings, the power grid connections, the liquid cooling systems. More AI workloads mean more server racks and power density upgrades.
And lease capacity, I assume. These AI companies aren't building their own warehouses, are they?
Generally, no. They lease space. Companies are leasing huge amounts of square footage to run these models. The report notes that if bond issuance to fund AI infrastructure continues, these buildouts can stay supported. It's a financing cycle that feeds right into real estate.
So who are the tickers to watch here?
We're looking at Equinix. The ticker is EQIX.
EQIX.
And also Digital Realty. Their ticker is DLR.
DLR.
These are basically the landlords of the AI economy. As long as the demand for compute rises, the demand for their square footage and their power capacity rises with it. It's a very tangible way to play the theme. You don't have to guess which AI model will win, ChatGPT or Claude or Gemini. You just bet on the warehouse they all live in.
I like that. It's the landlord play. Okay, let's look at the third category of winners. This one is a bit more psychological, I think. Low-cost indexing and passive flow proxies.
This is a notable reaction to the uncertainty in active data. The logic is that if the narrative around active data and analytics starts to wobble meaning, if people stop believing that paying for expensive data gives them a trading edge, investors tend to revert to the mean.
So instead of trying to beat the market with expensive tools and high fees, they just buy the market.
Correct. If the tools for active management are under pressure or being commoditized, capital often just flows to the path of least resistance.
Passive flows.
Passive flows, the big index tracking ETFs and firms can continue gathering capital even in what we call choppy tapes or, volatile markets. If you don't trust the data to pick a winner, you just buy the whole basket.
So who stands to benefit from that shift?
Well, the giant in the room is BlackRock. The ticker is BLK.
BLK.
They're the massive aggregator of these passive flows. And specifically, the report points to the iShares Core S&P 500 ETF. The ticker for that is IVV.
IVV. Now, hold on a minute. This is kind of ironic. S&P Global, the company we just said is in trouble, owns the S&P 500 index. But the ETF that tracks it is a winner.
It is a nuance of market structure. S&P Global gets a licensing fee, yes. But the volume of money moving into that ETF benefits the ETF provider, in this case BlackRock, immensely.
Hmm.
And the passive vehicle itself is seen as a safe haven, whereas the analytics division of the parent company is the part that's under pressure.
So the product is safe, but the company selling data about the product is at risk.
That is the distinction the market is making.
That covers the winners: chips, landlords, and passive funds. Now we have to look at the other side of the ledger, the losers. And naturally, we have to start with the companies that look the most like S&P Global.
Yes, the credit ratings and index owners.
We already mentioned S&P Global, ticker SPGI, but this affects their peers too. Why is that?
It's because of read-through. The guidance shock from SPGI spreads to its direct peers because investors immediately ask, is this just an S&P execution problem? Or is the whole industry hitting a wall?
And what's the concern specifically regarding the business model there?
Well, they begin to question the durability of pricing power. Can these companies keep raising prices for their data by 5% or 10% every year? They question sensitivity to issuance volumes, meaning if companies issue fewer bonds, do ratings agencies just make less money?
And finally, the moat.
Finally, they question that long-term AI moat around their proprietary data. If the data isn't special anymore, the margins aren't safe.
So who gets dragged down in this basket alongside S&P?
You've got Moody's. The ticker is MCO.
MCO. They're the Coke to S&P's Pepsi in the ratings world.
Exactly. And then MSCI, the ticker there is MSCI.
MSCI.
Right. MSCI is heavily reliant on subscription-based analytics and index licensing. So if the market thinks AI can synthesize market data cheaper than MSCI can sell it, well, their valuation multiple comes under pressure.
It really does come down to that fear of the moat drying up. If your data isn't unique, you're just a utility.
That is the fear. And utilities don't trade at 30 times earnings.
Let's broaden the scope to the next category of losers: market data, analytics, and exchange information services.
This is where we talk about AI tool pressure.
AI tool pressure. Explain that for me. What does that mean for a trader sitting at a desk?
It refers to the fear that cheaper, automated research could impact sentiment across platforms that monetize terminals, feeds, and analytics bundles. I mean, think about it. A bank pays thousands of dollars a year for a premium data terminal.
Right, it's a huge expense line.
Well, if an AI can scan the market, read the filings, check the sentiment, and give you a summary for free, or say for $20 a month, why are you going to pay thousands for the terminal?
So it's a deflationary pressure on information.
Yes. So which companies fall into this bucket? NASDAQ is a key one. Ticker NDAQ.
NDAQ. Now, most people just think of them as an exchange, a place where stocks are bought and sold.
But that's a misconception. A very large portion of their revenue and their profit growth comes from information services,
Sure.
selling the data that's generated by the exchange.
And the other one,
Intercontinental Exchange, ticker ICE.
ICE. They own the New York Stock Exchange.
Correct. But they are also a massive data giant. They sell mortgage data, pricing feeds, all sorts of analytics. The market is worried that AI tools will pressure the pricing power of all those bundles.
It's the same theme again: commoditization.
Yes. If the insight becomes a commodity, the vendor loses its leverage.
We have one final category of losers: risk and insurance analytics.
This is what we would call a sympathy move.
A sympathy move, meaning they didn't do anything wrong, but they just hang out with the wrong crowd.
That's pretty much it. When the market sells off information services because of disruption risk, adjacent analytics names often get hit as well, regardless of their own near-term fundamentals. You know, algorithms and portfolio managers will often just trim the whole sector basket at once.
So who are the names here?
VRisk Analytics, ticker VRSK.
VRSK. They do insurance data, right?
Yes, heavily involved in insurance risk. And the other is Fair Isaac, ticker FICO.
FICO, the credit score company.
Right. Now, think about FICO for a second. A FICO score is a very specific regulated standard. You can't just have an AI guess your credit score. Banks need the official FICO number.
So their moat should be deeper.
Theoretically, yes. But the stock trades as a high multiple data analytics company. So when the sector's valuation compresses, FICO often compresses with it. It's guilt by association.
So we've covered the landscape. We've got the infrastructure and passive flows, building the AI, buying the index, and we have the data owners and analytics firms losing, fearful that their product is being devalued.
That's the current division of the board. It's a classic market rotation based on a new variable.
As we wrap up, what should our listeners be watching next? We don't want to leave them with just a history lesson. What are the trading takeaways here?
Okay, there are three specific things to watch in the coming weeks. First, look for any follow-on analyst downgrades. When a major player like SPGI guides down, analysts often have to cut their price targets across the entire sector just to align with the new reality.
It's like a domino effect on the ratings. One falls, and the rest have to adjust.
Second, watch for management commentary on AI product roadmaps. These companies, Moody's, MSCI, NASDAQ, they need to show that they are using AI to enhance their product, not just getting eaten by it.
They need to control the narrative. They have to say, AI makes us faster, not AI replaces us.
Correct. And third, observe if their peers echo the same AI disruption narrative in their upcoming calls. If Moody's or MSCI comes out and says, yeah, we're seeing the same thing, then it confirms a sectoral trend.
But if they say, no, we're fine, our margins are great,
Then it might just be an S&P global execution issue, and the sell-off in the other names might be a buying opportunity.
that is a crucial distinction. And finally, is there a specific level or a tape read to watch?
The report suggests watching SPGI specifically. If SPGI cannot reclaim its post-earnings breakdown level within a few sessions, the group may stay under pressure. It really needs to find a floor.
So keep an eye on SPGI. If it stays down, the whole data sector likely stays down with it.
That's the signal.
All right. We categorize the winners, the losers, and the logic behind the moves. It's a clear picture of a market grappling with the new technology and what it all means for the value of information.
It is going to be a volatile transition.
Before we sign off, a quick reminder to everyone listening. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Always do your own research.
Thanks for joining us on Breaking News to Trading Moves. We'll catch you on the next one.